This is John Pastore. I'm sorry to get a little bit of a late start on that, but we're here to talk about part two of the CARES Act. And our speaker tonight is Jay Jackler. But I'm just going to say, you have a group here. I think what I would really like to do, if people want to ask questions as we go through this, just raise your hand. I'll honor you, or I might even just unmute the presentation for the individuals that are on here so we can talk and have a real discussion. So Jay Jackler is going to talk tonight about the tax advantages of the key provisions of the Corona Aid, Relief and Economic Security CARES Act. Now, many of these provisions people do not know. You hear about the relief that comes from the CARES Act for businesses and small businesses, but he's going to talk more about, in addition to that, about some of the tax relief that is there. And so what I'm going to do is I'm going to shift over and let Jay talk about this. And if you have questions, just let me know. Maybe we can address them as they occur. Jay?
Good evening. Thank you for spending the next hour with us. Hopefully we can make this impactful to your business, your practice, and your personal life and your finances. There are a lot of things to talk about in so limited time. So other than telling you my phone number and my email address, if you have follow-up questions, or you can call John Pastore and he'll get a hold of me, would be fine. Next slide. This is a disclaimer, which basically says I'm not rendering advice to your particular business. It's up to date as much as possible, but some of these changes are coming out hourly. So I did this morning, and I don't have any changes from this afternoon, except a few I read about. I'll be speaking during the presentation. Go ahead, John, please. I'm going to start with, before the taxes, is the thought of it's time to re-engineer your practice and re-envision it. The first thing that comes to mind is facilities. The waiting room that we've had of the past may need to change with social distancing and touch points within the waiting room. And this is going to cost money. So let's talk about what are these costs. So also, is it time to upgrade internet connections? Is it time to update computers for telemedicine? What's coming about? So let's look at the facility costs, and they'll dovetail into how do you pay for it, is either between the loans and tax benefits. Same thing with your operations, telemed versus remote. How do you take the patient's information? Do you end up buying something like Alexa for your front desk so the patient doesn't have to touch the pen and clipboard that everyone else in the world has touched? Or do you have to have that cleaned after each patient has touched that? And of course, the capital to do all these magical things when you're also reeling from this practice. Just some things to think about in the beginning of this. Keep going, John. Unless you have a comment.
No, just a second. There you go.
I'm representing the summary of the CARES Act financing options. And I've shortened it a bit, but the reason why is the Senate has already approved the $484 billion new coronavirus aid, and we're waiting for the House, which should be on Thursday or tomorrow, to approve it. The deal includes additional $310 billion for the Paycheck Protection Program, and specifically $60 billion for community banks and smaller lenders, as well as $75 billion for hospitals, $25 billion for testing, and $60 billion for the EDL loans and grants, because these funds have been used up already. What we found is most of the banks were preferential to their largest customers who had loans outstanding, because they wanted to make sure these customers didn't default on their other loans, and loans were provided with not on first come, first serve. And I find that a lot of our clients are relooking at their banks as a result, and payroll service are looking for alternatives, in which we've discussed because of the treatment, which was either very positive or negative as a result of this. Going over, because if you haven't applied, I suggest you apply now for the PPP loan, which is the dollars you can have for 8 weeks of payroll. Very important of what costs are in there. There's definitions that came out yesterday, late in the afternoon, about the self-employed owners. Do we have anybody who is self-employed who would like to hear about those? Can you get a raise of hands on that, John?
Okay. You can just raise your hand and I can tell you, whoever.
Yeah, I don't need to know names. I just want to know if anyone.
Yeah.
I won't key on that. What do we?
No, we've had a raise of hand. Yes.
Okay. The self-employment loans, what has come out with the SBA, you can either be a member of an S corp or employee of a regular corporation, or PA, professional corporate, or PC, professional corporation. You have partnerships or LLCs in which the owners get a guaranteed payment and a distribution. Those amounts should be applied for at the partnership level, not the individual level, according to the information that came out yesterday. And the true self-employed would be the sole practitioners and they said that the income is limited to $100,000 a year, divided by maximum loan amount is $100,000 divided by 52 time, or 12 months, divided by 2.5 is the maximum loan amount. And they're going to give you 8 weeks or $14,000 for your cap on self-employed. It does not include, as of yesterday, additional healthcare costs and other costs that are allowed for an employee. I think that's an error, but they're trying to make money go around, so they invent new rules as it happens. The initial consideration was to allow 100,000 plus benefits. Now it's 100,000 all in for the self-employed only. They're also saying it's not to exceed your net self-employment income the previous year. And they're also, if you weren't in business the previous year, you can look at the first 2 months of this year. So there's a lot of different calculations to look at with alternatives to see where you can get the best advances, and also how much you get to keep of it. Because just because they gave it to you does not mean you can keep it. We'll be talking about that in addition when we talk about the loan forgiveness. The loan forgiveness comes 8 weeks after you have to apply for it and show that no more than 75%, no more than 25% of the proceeds were used for utilities, rent, and mortgage interest. In the SBA opinion that came out yesterday, they indicated that self-rental, where you rent your home to the practice, does not count for this privileges, nor the percentage of your home mortgage that you're paying from your practice. They got a little more specific on that, but I'm waiting for also IRS guidance to come on it too. They also are looking at making sure if you didn't claim it in 2019, an office and home or some of these other costs, they're not going to give it to you in 2020. So how you file your 19 return, or now's the time to amend it is very important. The EIDL loan, the advance of 10,000 comes off your PPP loan when you get one. You don't get both. The EIDL, you get to keep the portion that you use for working capital other than the payroll costs, the utilities, and rent that you paid for the PPP loan. The Main Street program is the program for businesses with up to 10,000 employees and $2.5 billion of revenue. They're large facilities, but again, if you're re-envisioning what your practice is and you have a group practice, that is another possibility for you to look at. The U.S. Treasury for large companies over 500 that are not in the hospitality business. Those have been listening to the news. Have heard how Ruth Chris and other chains, the Shake Shack was able to get multi-million-dollar loans for a small business. And the reason why is they said anybody who had special industry codes starting with a 72 or hospitality was exempt from the aggregation of locations. And that's, other than those industries, aggregation does apply. And restructuring, if you already have an SBA loan, you're at an advantage because they'll do something about it. Any questions about the CARE Act financing options before I go on?
And just a question, could you raise your hand if you have applied for the PPP loan? Just so we get a little
sense of the audience, that would be helpful.
Yes.
Let's close it out in 5 seconds. Okay. 1, 2, 3, 4, 5. And John, since I don't get the poll answers,
okay,
if you just let me know.
Yeah, no, it doesn't indicate that people have. Okay, I know one of the other people that did attend last week, who's trying to attend this week, he has. So, all right, and go on, Jay. Do you want me to advance that slide?
Yes, please. I think you have to use the arrow on top.
Yeah, no, I got it. There we go.
Okay. We're talking, again, I used a slide from the previous presentation, is the devil is in the details. The 8 weeks that you pay is from the day of the loan origination or funding date. And then they're going to look at how many full-time equivalent employees did you have on either 2 measurement dates, or in how many did you keep to see what you get. And there's some math you do that people are likely not to keep all the money because they can't spend it all on rent and utilities. They're limited to the mortgage, rent, utility payments. They're going to have to bring copies of, or put together documentation that they paid these things, that the leases were in effect before this date. And also my recommendation of a separate checking account to show the money out of it still holds. So the takeaway to avoid reduction forgiveness is to make sure you have the right FTE counts, the right payments between that period. If you don't have it, you have 2 years to pay the loan back at 1%.
Okay.
Next page, please. I'm very excited about this because I've been doing a lot with net operating loss carryback changes. The ability, and I've also, in reviewing 2019 tax returns, I reviewed one for a client today that had his preparer do it, and their software wasn't up to date, and they had limitations. So rather than have to amend 19 when the software is updated, we've told the preparer to keep it on extension till his software is updated and the proper changes are made. In this case, let's talk about a net operating loss. A net operating loss from a business is when you have more expenses than income. So you have a loss. When the 2017 tax law was passed, the TCJA, they canceled net operating loss carrybacks. They said you could only carry them forward. That was a huge change, but the CARES Act has undone this. Now the net operating losses can be carried back 5 years. So if you had incurred one in 2018, now you can go back to 2013, which are higher dollar years, or if you have one in 2019 or 2020. So in some cases, our planning point is we're trying to create a loss in 2020 and go back 5 years, 19, 18, 17, 16, 15. So I'm going back to 2015 and filing in a form 1139, which is the carryback claim form, this loss and taking it against a year which I had higher tax dollars to be paid. How can you do such things? You can use a defined benefit pension plan in some cases, if that's appropriate. You can buy fixed assets that we talked about if you're going to be redoing your operatories and waiting room or equipment for telemed. All of this can be expensed in 1 year and can create a loss. Plus your practice revenue, God forbid, is down slightly. So that's very exciting. And a planning tool is getting money you paid already back. So the planning tool is if you have a loss, or should you be creating a loss? Other than getting covenants waived, but no one is shocked by having a loss this year with business closed. You may also have to look at marketing or patient reacquisition costs, as well as staff costs, depending on how you manage them during this period. So there are loans available, so you can borrow money on the loan for some of these projects. At this point, create a loss, carry it back, and get money. If you were in the 39% bracket for $100,000, you'd have $39,000 coming back to you, which you could apply to the project. And it's also helped your practice grow or maintain itself as a result of this. Next page, please. This is the only time I ever get to order John Pastore around, so this is like wonderful.
It seems delayed here, I'm afraid, so. Okay.
You're doing great, John. I appreciate it. So there was for corporations, there was a NOL deduction cap of 80% of income. That's been removed by the CARES Act. That went in saying, notwithstanding you had a terrible loss, you can only offset 80% of your income. After 2020, or the tax year calendar 21, you'll be subject again to the 80% limitation. So very important, do planning, and this is timing of accelerating of costs at the end of the year in particular. Now's the time to start the blueprint, which I showed, of what you're planning for your business. And then a bullet, as a result of the CARES Act changes, any taxpayer with eligible NOL may request the 5-year carryback. Corporations can do it, individuals, trusts, and estates. All very important facts to remember as a walkaway, because you're getting money back from the government. from something you were going to do anyways.
And
Next
I have a
slide.
I have a question for the group. And the group, if you just did a hand raise, how many of you really feel that the way you do business going forward after COVID-19 is going to be different? Could you just raise your hands? Okay, I've got one that says yes. And you know, might it change your practice, or think how you would operate your practice? Okay, huh? Good.
Let's
Okay.
put it another way. Will people be willing to sit shoulder to shoulder in a waiting room like they used to,
Yeah, I talked to
without
some people.
filtration or other mitigation?
Yeah, I talked to several
Go
people
ahead, John.
today. Yeah, I just mentioned one thing. I talked to several people today, doctors, and they said, yes, it's going to change how I do things. And we're going to be doing much more with telemedicine, and we're going to be doing much more with virtual rooms where people come to. So, or they meet. So we think that's a big area to discuss and to consider. And that's why you consider it now with all of these loans available.
John, I also, one of the presenters I was with, we talked about negative pressure rooms, so that when you had to isolate somebody who came in who was symptomatic, you wanted to keep him or her away from the other patients. And that's why you needed a specialty room to do that. And some practices are looking to that also.
Yep.
Now, for the exciting part, the IRS announced on April 9th that it suspended virtually all paper filed individual returns until further notice. And its ability to process all other paper filed returns is extremely limited. What a surprise. So they're telling you to file a net operating claim or some other adjustment on a piece of paper, which they're not going to look at. Starting on April 17th, the IRS will now accept the paper refund claims, the Form 1139 that had been mothballed via fax, and refund claims for corporations, which is called a quickie claim. I've provided the fax numbers of 844-249-6236 or 6237. So there is definitely a way to get them the news. I don't know why a fax will help them. And of all things, the IRS has never been available to e-file a refund claim, or because you had to attach both the original return and the refund claim. And that seems to be too complex for the computer system they have, which hopefully they can fix as a result of this in their operations. So I provide the phone numbers and knowledge for you. So if someone tells you to go mail a paper claim in, it's not going to be looked at. This is how to get it moved faster.
Okay.
Next page. All right, I'm what's called a code head. This is section 165I. While my roommate in college was a pre-med student, I was a Wharton business student. We looked at each other. He helped me with my PChem, and I helped him with his accounting work, so we got to understand each other. But sometimes you need a few code sections to support what you're saying, or tell somebody you're using who doesn't know about these rules where to find them and back up. Even if you have a cocktail party discussion, this is great backup to saying, don't you know about section 165? This lets you take a loss otherwise deductible in the prior year if it's attributable to federally declared disaster. Well, 2020 was a federally declared disaster effective March 13th. So the subsection H5 lets you take a personal casualty loss attributable to a federal declared disaster from 2018 through 2025. So big stuff that you can carry back, and I'll show you why on the next slide.
Wait a second. Before we do that, we have to acknowledge that Robert T. Stafford was from Vermont.
What do you think I put that in for?
Okay.
But thank you for bringing it to attention. Losses of a business are not limited to casualties. An example, in March, the state issues a shelter at home order. Practice moves entire office staff to remote networking at home. 75,000 of computer and office equipment was destroyed in the move. Insurance has a $10,000 deductible. The $65,000 loss can be deducted in 2020, or the company can elect, or the practice can elect to take this loss in 2019, which from a timing basis gives you a deduction a year earlier. Either you pay less tax or get money back a year earlier. So let's remember the 165I example for business, and then the next page, John. Capital gains. There's a possible relief for the 2019 capital gains under these casualty rules. Let's say you had a gain of 219,000. I'll use example 2 because we sold our practice. And then I invested the funds in index funds. The fund dropped in 2020 and was sold at a $300,000 loss. This election will allow you to take the loss back against the $500,000 gain, because losses usually are $3,000 in excess of gains. So if you never, usually the spouse will yell at the other part, the other spouse, and say, don't ever invest in the market again. So at $3,000 a year, that's 100,000 years before you could ever use it. So we'll never use that loss. This would allow it to be carried back to the previous year and make use of it. Same thing with the had capital gains of 500,000, the sale of an industry stock as example 1, say a hospitality stock, and lost 300,000 due to the COVID-19. You can take the loss of 19, reduce the gain to 200,000. So 2 different examples of the same set of facts that allows you to make better use of your loss in the market.
Well, that's a good reason to review things and to take a closer look.
Absolutely. All my clients bring me, if possible, 5 years tax returns so we can have a game plan. The next 3 pages, I've just decided to give everybody a list of what are the provisions in this CARE Act that have any tax things to look at. You can consider them. Number 1, if you qualify, which a lot of people didn't, is the individual rebate credit, which starts to phase out at 150,000 of a married couple. For a retirement plan distribution for underage 59 and a half, there's no additional 10% penalty for coming out for doing that. And if you really in emergency needed money for 59 days, not in here is you could roll your money out of one plan into an IRA. You have 59, actually 60, but I always tell my clients 59 days to replace it. So you have 59 days use of your money without interest or taxes because you're going to replace it. There's a provision, now there's pages behind these things, but I thought it would be overwhelming, so it give people a checkoff list if they wanted to hear more of something. There's a limit on plan loans was increased from 50,000 to 100,000, and the repayments of those loans are delayed. Again, when you see retirement plans, you might have life insurance that you could borrow against. You might have other items that you should consider. You shouldn't look at these things in a vacuum. John, do you have the ability to analyze people's finances and tell them the different alternatives, tax-wise and retirement-wise?
Yeah, yes, we do. And we work, as you're going to see in my slides, alongside the attorneys and the CPAs like yourself to do that analysis and to dig deep. And that's all part of our process in doing overall planning. I would say to you, don't react to these. These are provisions that are there. There are certain specifications underneath them with the loans that you have to qualify for. They're right now fairly open-ended from that standpoint, but you need to really build them into a plan to understand what the best option really is for you. And we'll talk a little bit about that later.
Okay, great. Thank you, John, for clearing that up. The next one is the required minimum distributions were waived for 2020. So that means it's trying to help you make up if you had investment losses in 2020, is you can bypass that year. Again, you need to analyze, you're allowed to take the money, but you're not forced to take the money in 2020. There's no carryover where you have to make two distributions, but at the first of next year, when you determine an RMD, you have to then take the remaining life longevity times whatever balance is there. So it's somewhat of a resetting of that distribution pattern. This is an interesting one. The tax excluded education payments by employer include student loan repayments. Let's say I want to pay an employee who has a student loan, not pay the payroll taxes, and not have them have to report it as income. I could pay them, instead of some compensation, a student loan or their bonus this year as a student loan repayment. The practice can deduct it, and the individual doesn't have to pick it up as income, so that makes that much money. And there's a limitation on how much, but you should consider plans for that, because you want to keep some of your key younger staff. And people always ask, what can I do for them that doesn't cost me any money? Well, here's one of the ones, because that escapes the retirement plan contribution. This also escapes the payroll taxes on it. And it also helps them because they don't have to pay income tax on it. Next slide, please. There's a high deductible health plan, safe harbor for telehealth services, and also for the high deductible plans, they've now included certain medical over-the-counter items for females that are allowed on it. There's a $300,000 above the line charitable deduction, so it makes a difference now. And if anyone has food inventory from a hospital facility, they were donating it, there's now a increased contribution deduction on the food inventory. There's employee retention credits for employers. There's the delay of payment of employer payroll taxes. The payroll taxes will come due when if you have a PPP loan, that comes due the same day the forgiveness happens or later. It's half at the end of this year, 2020, and half on 21. There's advanced refunding of credits for paid sick leave and paid family leave. We've talked about the net operating losses, which I've done a lot of planning already for various practices and businesses because they're re-engineering themselves. The deduction of interest expense temporarily increased This is one that some of the software hasn't been updated yet, depending on who your provider is. I had one return today that I reviewed, and it was missing. The cap is 50%, not 30% on interest expense. Again, it's a percentage of the net income of the business. We've talked about the forgiveness of the Paycheck Protection Program loan. Definitely, it's non-income when they forgive the loan. What it does come into question, and we're still waiting, as I told you last time, whether those costs can be deducted or not. So if you paid payroll to an individual and the reimbursement you had to pay the payroll was tax-free, the question is that payroll that you paid also deductible? There's no answer on it, and that's one of the questions we're waiting for direction on. There's a corporate minimum tax credit, and that has to do with certain tax preferences of a PC. I do a lot of work with both docs and all kinds of businesses that have aviation involved in them, either aircraft or transportation. And we're seeing more of that now where people want private transportation, even if it's a charter, so that they don't have to sit with their family in the airport and get exposed to other people or people on the aircraft. This bonus depreciation technical correction for qualified improvement property, that's a mouthful. My roommate would have never understood me, so let me try to explain it a different way. When they drafted the 2017 law, they forgot to discuss certain leasehold improvements, and particularly for retail type of spaces, or which is spaces meeting with the public. So it could be like your rooms, your waiting room, etc. And they put it out to a leasehold improvement, might be a 39-year life. Instead, it's they reinstated and corrected it to be a 15-year life. Now, what's the big deal of that is, since it's a 15-year life, it now qualifies, it's used for business, for what's called bonus depreciation, which also means I can deduct it all in 1 year. So here I have, I did a $39,000 improvement, which means I was going to deduct it $1,000 a year for the next 39 years of the practice. Then they changed it to 15-year property, and 15-year property temporarily is you can write it off. So the deduction is $39,000. Well, they retroactively corrected this to 2019. So I'm amending some returns and getting people back for this additional depreciation they were allowed. And many people ask, why would you do it? You'll get it eventually. And I would say the time value of money of 39 years, $1,000 a year deduction versus getting it yesterday would be much better. And I think that's the last of my pages, John. So I left it open for questions or for you to dovetail your section.
So what I thought I'd do, well, first, thank you, Jay, so much for that. And I'm sure this is a lot of information for everybody to take in. We all aren't accountants, but what I can tell you is what Jay looks at are the creative ways to use accounting to save money. And what you heard today was you can even go back and get taxes back. And so maybe there's some creative ways to do that. Well, what we've done over the years with doctors is we help the doctors make their financial decisions. And we use the same process that you use in your normal course of your business, which is to assess the situation, research it, maybe bring in consultants, other doctors with specialties. Once you know what's there, prescribe it, monitor what's happening, reevaluate, and work right through the whole process all over again. Well, the key is really to help you in an area where maybe you may not have that expertise of knowledge and to bring that to the forefront. So what I said that I would do, and we didn't really get out to announce all of this because this is, we felt with what happened with the CARES Act being held off for a while, that would be a good idea to kind of get into more of the personal financial recovery, because I think everybody's interested in that. And my little checklist is, well, first, you got to know what you have, so you organize your finances and make it simple so you can get it back to it easily. Then once you know that, you develop a plan to get back on track. Well, what Jay talked about today was envisioning your future. And he talked about the fact that the CARES Act really provided some extra advantages, not only from what you could raise with capital, but what you could do with it and how you could save on taxes. He talked about employee benefits and write-offs and redesigning things. Well, I talk about using them. And then updating wills, trusts, and healthcare directives. I think today we've learned more about that than anything else, that when we are isolated and alone, we begin to think, well, really, what have we done? And the last part is to review. So let me try to just explain this, because many of you may not know it, but being the affiliate for financial planning for the Vermont Medical Society, we really offer this as like an additional benefit to you, and there's no cost for this. So when you organize your finances, you can do it on a piece of paper, but you're going to have to update that piece of paper regularly. So what we actually offer the members of the society is a financial website. So it's a website that you can basically put all your information on. It's a secure website. It will be updated automatically for you from wherever your information comes, be it loans or be it from investments or whatever. And with this, you get a good overview of where you're at. But what most people are asking today is, this market is going up and down, mainly down up until now, a little bit up, it came up today. But what do I do from that standpoint? Well, you've got to develop a plan. You've got to get back on track. And that means probably the first thing is figure out what you're spending or what you will be spending and what the tax implications of that, with what Jay's talking about, might be. Well, I think what you want to calculate is, what do I have no control over? I've got to pay these things regardless. Those are non-discriminatory expenses. But then there might be some other ones that are more the fun expenses that maybe aren't quite as important. But you got to understand what it takes to get back on track. What do you need to have? Then when you get this, and you can even plug in the tax write-offs, the savings, into this particular software, you need to say, well, where do I stand? Well, with the market, maybe you're planning to retire at 60, maybe it was 65, maybe it was 70, who knows? With this market drawback, you might review that plan, and on the left, you might say, I wanted to retire at 60, but I can't, it's not going to work. In other words, that little blue area is dropping down. Those are the investments. They're petering out before, I peter out. So maybe you have to look at, should I retire later? Or should I spend more? Should I spend less? Should I save more? Do I need to? You need to determine what does it take to get back on track? And you need to probably take a look at asset allocations. You need to look at dollar cost averaging maybe into this market over this period of time versus, timing it is a very hard thing to do. But rebalance, protect yourself on the downside. Do whatever it is that you can do to make yourself feel comfortable you're going to achieve what's there. Now, if you have questions, I'm more than happy to answer them, but I'm going to just kind of go through this. Maybe hopefully we figure it out from here. Now, Jay talked about all of these reasons or these ways to raise money. The PPP loans for payroll, the economic injury disaster loans, and some of them are grants, some of the tax credits. And then he talked about even being able to get taxes back from the IRS. If you sit down and you can envision what your future is. And I really think that's the key of this. Envision where you want to be. And I think, I've always said, I think my mantra is that minds work best when they're open. So if you change your thoughts about the future and look at it positively, you can change your world. And that's what planning is all about. Some of you, I think most on the call tonight, have their own businesses or are parts of group practices or even affiliated practices. You may want to look at, those hardship loans that Jay talked about, the withdrawals. You may want to look at redesigning a pension plan to get a larger deduction, to create a loss and back or whatever, okay? And you may be an employee of an institution where maybe you ought to take a look at, are you really maximizing what you're able to do that's done with pre-tax money? We find most people don't use the benefits to their maximum. They need to kind of look through that. So I'm just kind of giving you an overview of what I see that people should really do at this point in time. Now, wills, trust, and healthcare directives. If you haven't looked at a will in the last 3 years, maybe you ought to take a look at it again. If you don't have one, maybe you ought to consider putting one together. A trust can take many different forms. A trust can be very simply something where money pours into. Let's say you have young children, and those children might use the money in the wrong way. It might be a trust that gets created after your death, and it might hold money and tell them how to spend the money versus just plain old go out and spend it. Might hold it off for a while. In healthcare directives, you deal with it every day of your life, okay? I'm sure you've had experiences where people have walked into the hospital, they've had problems, they have not had the directives available. Maybe things were done that maybe they didn't want to have done, but that really stands true for your own family, that you have those directives pulled together and updated. And that's all part of looking at the entire process or the big picture. And that's really what we're talking about, is looking at the big picture and using this planning that's available now, what Jay's talking about, as an opportunity. So how it all comes together is that when you solve a plan of any sort, or even a tax problem, it's kind of like solving a Rubik's Cube. You really have to use all different sides to the program. You need to have a lawyer, you need to have a CPA, hopefully you have a planner also. Those people align the sides into a coordinated plan of legal, tax, investment, insurance, retirement, and estate planning. So you wind up with a coordinated cube from that standpoint. And I think that, from your standpoint, what I really feel that people should do is just explore right now. We have a little extra time on our hands generally, and we should explore and see what the options are. I'm going to play a quick video. I think probably this video is more meaningful today than it ever has been, because a lot can happen in a year, but this is really talking about why you have to look at things and how fast and how they can change. And this is a little bit about what we do with the doctors. So I hope you can hear it. I'm pretty sure you will be able to.
A lot can happen in the course of 1 year, and it usually does. As things around us change, we change too. Our priorities shift. Our goals evolve. Because life isn't static, your finances aren't either. That's why an annual review is so important. It's a time to get together and look back at what's happened in the past year. Evaluate how it could affect your future. then make adjustments to get you back on track to help you achieve your goals. We'll ask the key questions about your personal finances that need to be answered each year. We start with how your investments are performing. We'll compare your portfolio's performance against market benchmarks. Does your asset allocation meet your current investment needs and preferences? We may recommend rebalancing your portfolio if changes in your timelines or risk tolerance suggest modifications. Has your tax rate changed? We'll examine whether there are tax-efficient strategies that may boost your after-tax returns. How well are you managing your personal debt? We'll offer strategies to reduce your debt load or lower your interest rates. Does your personal retirement plan still reflect your priorities? We'll make recommendations and adjustments, if necessary, based on your future lifestyle goals. Have your insurance needs changed? Do your beneficiary designations need to be updated? We'll evaluate your requirements to assess whether you are properly protected with the appropriate products. We'll review your will and estate plan and note any items you may want to discuss with your personal attorney, especially if family changes have taken place in the past year. Your annual review is a yearly financial checkup that can give you a 360-degree picture of you. We'll answer the questions about where you are today so you can stay on track towards where you want to be tomorrow.
Okay, well, I did receive one little text from somebody saying that it sounded a little choppy, so we will find a way for you to get access to this video. But really, more importantly, what you have access to is answers to questions. So if you have a question about your own situation, we're here to help you in whatever way we can. And as a member of the Vermont Medical Society, you're entitled to your own personal financial website. And, with that, maybe we can have, if there are any questions, I will certainly entertain them. If you want to raise your hand, I'm more than happy to unmute you. But what I would say is probably some of these might be personal in nature, and we'd be more than happy to answer them afterwards. So I think it's a great opportunity for you to envision what you want moving forward, not just personally, but with your business, and take action. So are there any questions if you have it? And if not, maybe we can talk afterwards. Okay. Okay. Well, I want to thank everybody for attending. I hope you found this meaningful